If your US RSUs vested and the broker already shaved off tax in America, you have probably asked the same annoying question every engineer asks: am I about to get taxed twice on the same stock? The reason this feels so painful is that US payroll rules often start with 22 withholding on supplemental wages, and RSU income is treated as compensation when the stock is paid or transferred, according to the IRS publications from 2020 and 2026. So you open the vest statement, see shares sold for tax, and your brain goes straight to panic mode. But here is the part many people miss. Withholding is not the same thing as final tax cost. Foreign tax credit exists precisely because residents can get taxed on foreign income in India too. And once you see the flow clearly, this topic becomes much less scary. It is not magic. It is just matching one chunk of foreign tax against the same chunk of income in India. Before we do the math, define the two moments properly. Vesting is when the RSU turns into actual shares for you. Selling is a separate event that can create a separate capital gains calculation later. For the vesting moment, think salary, not investing. The fair market value of the shares at vest is the compensation number that starts the whole chain. Let us use one clean example all the way through. Say 100 RSUs vest at 120 a share, and for this example we converted 83 rupees to the dollar. That gives you salary income of 996,000 rupees at vest. Not potential value. Not future upside. The vest date value itself. Now layer India on top. If you are an Indian tax resident, foreign salary income does not become invisible just because the stock came from a US company. So now you have three ledgers in your head. The income at vest. The US tax withheld on that vest. And the Indian tax payable on that same vest income. That third phrase matters, on that same vest income. Foreign tax credit is not a general coupon you can stick anywhere. It has to be tied to the same doubly taxed income. On the India side, the Income Tax Department's Form 67 manual says residents use this form to claim credit for foreign tax paid, and it has to be furnished by the due date for the return. The same manual also says you need to attach a certificate or statement in proof of payment or deduction of foreign tax. In plain English, save the paperwork from the vest and do not depend on memory 6 months later. Here is the flow you actually need to remember. Vest creates salary income. The US may withhold tax right there. India still computes tax on the same income. Then you claim relief through the foreign tax credit process in the return. Now let us do the actual numbers, because this is where most explainers become fuzzy and useless. If the US withholding in our example is 22%, the foreign tax deducted on the vest income works out to 219,120 rupees. At the same vest price, that is the value of roughly 22 shares, leaving you with about 78 shares. Now assume you are already in the top Indian slab, so the effective tax rate on this slice is 31.2% including cess. Then the Indian tax on this same vest income is 310,752 rupees. And here is the rule of thumb that saves you from confusion. India does not hand out more foreign tax credit than the Indian tax attributable to that same income. So your usable credit is the lower of those two numbers. In our example, the foreign tax withheld is lower than the Indian tax on that vest. So the full foreign tax withheld, 219,120 rupees, can be used as credit against the Indian liability on that same income. Look at these four bars carefully. The first is the US tax withheld. The second is the Indian tax on the same RSU income. The third is the credit you can actually use. The fourth is what still remains payable in India after that's set off. So the Indian balance tax after foreign tax credit is not another full tax hit. It is only the difference, which in this example is 91,632 rupees. That is the whole emotional unlock. Without foreign tax credit, the same vest could have felt like a tax disaster. With credit, the total tax cash outflow comes back in line with the Indian tax on that income. This chart shows exactly that. The no credit path ends at 529,872 rupees of cash taxes on the same vest income. The credit path ends at 310,752 rupees, saving 219,120 rupees. Now let us talk about where people mess this up in real life. Mistake number 1 is mixing up the vest year and the sale year. For the vest itself, the matching income is salary income at vest. The later stock sale is a different tax event and needs its own computation. Mistake number 2 is assuming any US tax on the account can be claimed against any Indian tax bill. No. The credit has to be mapped to the same foreign source income that is being taxed in India. Mistake number 3 is forgetting the reporting side. The Income Tax Department's Foreign Income Brochure explains that foreign income goes into Schedule FSI, tax relief is summarized in Schedule TR, and foreign tax credit details go through Form 67 online. Mistake number 4 is waiting until return week to collect documents. By then the vest statement is buried, the broker portal looks different, and you are trying to remember exchange rates and tax entries from memory. So what should you do today if you hold US RSUs and live in India? First, create one vest folder. Keep the vest statement, employer payroll evidence, broker tax statement, and any proof showing what foreign tax was actually deducted on that vest. Second, compute the vest as salary income in India first. Only after you know the Indian tax attributable to that same income should you work out how much foreign tax credit is actually usable. Third, remember the ugly but important edge case. If the foreign tax withheld is higher than the Indian tax on that same income, India will not magically refund the excess through foreign tax credit. Your usable credit still stops at the Indian tax number for that income. And if the foreign tax withheld is lower than the Indian tax on that income, which is what our example showed, then you still pay the remaining difference in India. That is normal. That is not the same as being taxed twice without relief. Once you understand that one sentence, this whole topic becomes manageable. Foreign tax credit does not erase tax. It prevents you from bearing the full tax twice on the same vest income. If this helped you finally see US RSUs through an India tax lens, subscribe to WealthCode. We break down India personal finance the way engineers actually think, with systems, examples, and numbers that reconcile. Next, we are going to break down how to calculate capital gains when you sell vested US RSUs in India, including the cost basis, holding period, and the exchange rate trap that quietly changes your tax bill.